the same code that ChatGPT spit out to me. I'm using this code in order to create something like an overlay on with this. There is one final thing that we've added in our backtest report that I would love to show you, and that is basically an AI based summary. That is, in this video I will tell you the top 5 things you need to check for in a backtest when you are running a backtest of your strategy using this.
Please read the disclaimer carefully.
Hi, in this video I will tell you the top 5 things you need to check for in a backtest when you are running a backtest of your strategy. Using this we will learn about many different concepts of the backtest. So if you're interested in everything algo trading, do remember to like, comment and subscribe to this channel, as I will be teaching you a lot of different things today. Now the strategy that we are going to run a backtest for is basically the same strategy that I made in my previous video using AI. So if you haven't seen that video, I would suggest have a look at the button out here, and it should basically open that video, go through it, understand what is the strategy, how is it built, and then come back to this video. Now in this video, I have basically run a backtest of this particular strategy. The backtest duration that I chose was the longest duration possible, which is 2020 January till today, which is September 2025. So around 5 years of backtest. Candle frequency was 1 minute. Trade open price was selected, and it was an intraday strategy like I have created out here. Now, when I ran the backtest report, I got basically a result which looked somewhat like this, right? So I'll quickly enlarge this, and I will show you a couple of things in this video so that you are able to understand what is it that as a trader you should look for when you are running this particular backtest report. So you can see that this backtest report is of the same strategy that you can see out here, and the durations that you can see out here. Now, most people I know make the mistake of just looking at the PNL curve, and based on that PNL curve triggering that strategy to on live in order to run, right? Now you need to remember that while the PNL curves give you like a backtested simulation of what is happening, it is not exactly the best thing that you should look for in a backtest report. I'm not saying it's not important, but there are other things that are way more important than just the PNL curve, right? The first and most important thing that you should look for in a backtest report is right below the PNL curve, which is basically the drawdowns, right? Now, whenever you have a strategy is going to have a drawdown, right? Now, what exactly is a drawdown? Let's understand this with an example. So let's take an example of this drawdown and understand what exactly is this, right? So like you can see out here, this graph out here, the PNL curve is basically giving you the data on a daily basis. What was the equity of that strategy? So regardless of how much capital you had, let's say if a strategy made a profit of 1,000 rupees, that 1,000 rupees would basically be captured somewhere out here. Now, if on the next day it again made a profit of 1,000 rupees, this thing would basically go from 1,000 to 2,000 and so on. So assume that in your equity curve, you started off from something like 0, right? When you started from 0, it then goes to 1 lakh rupees, which means you have notionally made a profit of 1 lakh rupees. Now, after some time, let's assume that this 1 lakh from the equity of 1 lakh, you go to 50,000 rupees, which means that you have not lost any money out of your own capital, but from the max point that it had reached, which was 1 lakh, it has now gone to 50,000, which means notionally you have lost 50,000, or your opportunity cost has basically been 50,000 out here, right? Now, what this drawdown does, this drawdown is capturing that specific amount. So when you go to the top, and from the top, how much you go down in terms of equity is basically counted as the drawdown, right? In very simple terms. So let's say you started from 0. From 0 you went to 1 lakh. From 1 lakh you came back to 50,000, and from 50,000 you go back to 1 lakh. So you have basically, your drawdown out here is basically 50,000 rupees, right? So that is the drawdown, or that is how much your strategy has gone down by, and that is how much pain you will see as a retail trader. Now, it's very important to see the drawdown. Why? Because this is going to test your psychology. So let's assume you have a strategy, it's doing fine. As long as there is profit, there'll be absolutely nothing that you will want to do to stop that strategy, touch that strategy, and so on. It plays with the psychology. But the minute you see that there is loss, or there are continuous loss-making days, that is when you will think that maybe the strategy is not working anymore. Maybe I should stop running the strategy. Maybe the edge is gone, or anything else. Now, because of these kind of thoughts in your mind, you would want to stop that strategy, play around with numbers, or do something differently. But what you need to realize is that this was the normal course of action of that strategy, right? So the drawdown is basically giving you a number that you know that you are comfortable with, that okay, historically this strategy has given a drawdown of, let's say, 50,000. So now if, let's say, at any point you're seeing that there is a drawdown of more than 50,000, or it is coming near the 50,000 number, at this point you can now decide that okay, I need to reevaluate the strategy, see that what I had originally thought for, is that actually playing out in terms of the logic of the strategy or not, and so on. Another very, very important thing to remember out here is how long this drawdown lasted, right? So for example, let's say this 50,000 drawdown that we saw, let's say if it lasted for 5 days, that is okay, you can handle it. But if this 50,000 drawdown lasted for 200 days, which means that for nearly a year, you are seeing the strategy in red from its peak, you'd probably not be able to be patient enough to let that strategy run as per it is running as such. So it's also very important to see how long did this drawdown last. So this drawdown plot that you see out here in this graph, what it tells you is, one, how much of drawdown did it have in comparison with the capital, and the profit that had achieved. And this red part that you see out here, this red part is basically telling you the worst drawdown of the strategy lasted for how many days. So this red part is telling you how many days did it last for. So for example, I can see that the maximum drawdown, like even though I can see percentage wise the worst drawdown was somewhere around January 2020, but in terms of numerically, the maximum drawdown number that was triggered in this strategy was between this particular date, April 22 and October 22, and this particular drawdown basically lasted for 191 days. So this tells you how well you need to prepare psychologically in order to run this particular strategy, right? Again, you are basically getting how much percentage is lost in summary and how much time it took to recover. So based on that, you can treat the strategy accordingly when you are running it. Now the next thing a good trader will look for in the strategy would basically be the daily returns, right? Now let's have a look at what I mean by when I say daily returns. So when you see the backtest report out here, you'll see this one section which basically gives you the daily returns out here. So with this, I can quickly figure out at which time or on which days was my strategy most vulnerable, and based on that I can either check that these extra large candles, maybe it was because my TSL jumped, so maybe too high volatility causes issues to my strategy, or I can think in the directions of what happened right when these green candles were there. Did this large green candle happen because of slippage? Now you need to know that the backtest is basically running a backtest based on every 1 minute candle. So because this is running based on a 1 minute candle, there is a high possibility that, let's say, on 1 minute there was such a large move that it basically jumped my stop loss. There's also one more thing that you will see, which is the return histogram, right? Now it goes in parallel with the daily returns. When you see the return histogram, what does this graph tell you? When you see the return histogram, it is basically telling you, one, the percentage based returns. So this long green candle is basically telling you that 1% return happened how many times in that particular strategy. Similarly, this minus 2% return that you're seeing happened how many times in that particular strategy. So what this graph is telling me, the return histogram, what it is telling me is that around 400 times, so 400 unique instances were there when my strategy was giving me a 1% profit, and it stopped at that 1% profit. So 1% profit was the highest distribution in this particular graph. Similarly, I can see that in my loss, there were close to 100 times when I got a 2% or larger loss in my strategy. So now with this, I can use this data to strategically make better decisions with respect to my targets and stop losses of the overall strategy. Let me tell you how. So for example, in this strategy, I can see that since so many times I have got a 1% or more 1% target in my strategy, maybe I can choose to have, instead of a fixed target, I can choose to have something like a trailing stop loss in my strategy. And that trailing stop loss would basically get triggered, or it would minimum lock my profit, which would be at 1%. So I know that I will at least get this 1%, and if not this 1%, I will get at least something more than this 1%. Now, when I do something like this, assume I put a trailing stop loss where I'm capturing at least the 1% profit and then allowing the profit to keep increasing as and when the market goes in my favor. In that case, what could happen? You'll see that this graph, the graph of this 400 will basically reduce, and you should ideally see more number of candles being added out here if the logic was basically supporting the data and so on. Now, when you make a change, so for example, let's say I make a change in my trailing stop loss values, right, or my target or stop loss values, how will I get to know that the change that I made, it actually helped me improve the return of my strategy, or it actually made my optimization worse? How will I get to know about that? So one easy way to figure out this particular thing is that you can check these numbers. So I'll just quickly enlarge it. Yeah, you can check these numbers. So when you check these numbers, it is basically 17, 18 and 19. These three are giving you very important outputs out here, right? What outputs are they giving you? One, it is telling you that in the entire data set, if it is looking at the average profit or loss on a daily basis, it is able to see that you are getting around, let's say, 210 rupees of average profit. Like on an average, considering everything, all the trading days, which is I think total 1400 or so trading days, it is seeing that on an average out of this entire data set, you are able to make, let's say, 210 rupees of profit on an overall basis. And it is also giving you some other details like the average profit on the profitable days. So I can see that when my strategy was profitable, I was able to make an average of, let's say, 1500 or so. Similarly, the average loss on loss making days was basically minus 770 rupees. So if let's say I add certain trailing stop losses, and with those trailing stop losses, I'm able to see that these numbers from the 210, 1505 and 770 have changed, where let's say my average profit or loss on a daily basis from 210 has gone to, let's say, something like 225 or 300 or 400. In that case, I know that when I have made this change actually helped me improve the overall optimization. If I see the average profit on profit days has gone from 1500 to a higher number, this means that it has actually improved. Similarly, on the opposite side, the average loss, if it reduces while containing my stop losses, then I know that I am basically doing something right in my strategy, which is why it's basically optimizing for my return out here, right? So the third thing that you can do in terms of understanding your backtest report is something that is hiding pretty much in plain sight, which most people tend to ignore. And I will show you a good AI technique that you can use for this particular graph, and use this to optimize your entire strategy. Now, this data broadly is very difficult to understand. Why is it difficult to understand? Because as a human, I don't know if, let's say, in this month which is June of 2024, it made a 10% in that month in the backtest. Now, how do I know that June of 2024 was, let's say, was a bull run, or it was a bear run, or was it sideways, or was there any particular technical indicator forming on that day, and so on? I wouldn't know, right? So I am basically running this on a PineScript code. In this PineScript code, this same code that ChatGPT spit out to me, I'm using this code in order to create something like an overlay on my Bank Nifty. So now when I'm looking at this Bank Nifty on let's say a daily basis, I'm able to see that all of these green bars that I see, these are basically the profitable months that I had. Similarly, these red bars are basically the loss making months. So I can now see that this particular month was particularly a loss-making month. Similarly, this entire period was a profitable period. Similarly, out here, this was a loss-making period, and so on. You get the idea out here. Now, with this, as a trader, because I'm already so used to watching charts, as a trader, I'm able to look at these values and see for recurring patterns. So if you see out here, whenever there has been a sudden fall, so market fell out here, again it fell out here, again it fell out here, Similarly, it fell out here. So on multiple occasions, when there was high volatility or market suddenly fell, at that time, on a regular basis, my strategy basically gave me a red month on these situations. Similarly, I can see that whenever there was a bull run, so whenever there was a sudden increase in the market, or the market was sideways, right? So market is sideways. All of these situations were when I was able to make a good amount of money, right? These are all green months for me. So now as a trader, I can use this data to help me further optimize for whatever research I'm doing with the help of my strategy. Now, fortunately for you, I will not make you go through the pain of dealing with ChatGPT where you have to write this whole code yourself and then debug it. So yeah, this prompt will be in the description. Choose to copy it and use it however you like. So the fourth important thing in the backtest that you should check for is basically the rolling return metrics. Now, what are rolling returns, right? So first let's understand rolling returns. Now, rolling returns is basically like when you started your investing or trading at one point and you ended it at one point, there is a possibility that market may have done certain things during that point of time. So for example, I have the corona time on this chart out here, and I can see that in corona market started from, let's say, some 17,000-18,000 or so, and after corona, like till 30th November, it went as much as, let's say, 41,000. So you're seeing that nearly 150% of return between these two periods. Now if I say that just change the period from 1 month before that, so 1 month before corona, which would be something like this. So from 30,000 it basically went to, let's say, 1 month before this high, which is August. So 30,000 to 35,000, which is hardly 5,000 movement, 5,000 point movement in that 1.5 year. So the return of the first person who saw that full fall of corona and the increase versus the return of the second person who started just 1 month before, his return profiles will be completely different. So you can't just look at the return of, let's say, two different periods, because there is a possibility of bias, because the market may be at one point at the start point and one point at the end point, right? So rolling returns is basically telling you that if you don't look at the two points as the start and end point, you look at between these two periods. You're always looking at the returns between these two periods, which is a fixed number. So between any 2 points, you are basically making sure that you are looking at the return between a particular return back rollback window. Now, when you're looking at these rolling metrics, you are able to see two different types of rolling metrics, which I think are very important out here. Now, one is basically the Sharpe ratio, which is again being done based on a 21-day period. So it is looking at 21 days and the Sharpe ratio is being plotted for the 21 days. So like I gave in the example right now. Similarly, it's giving you the volatility in the 21 days. Now, what exactly is Sharpe? Sharpe is basically like a number which gives you a risk-adjusted return. So, for example, let's say I have two strategies. Both are making me 1 lakh rupees, right? In one strategy, the MTM swings of the strategy are basically 25,000. So, on a daily basis, I could see 25,000 of loss or 25,000 of profit, right? On the other strategy, I can see only 500 rupees of an MTM swing. So at max, it would go up by 500 or down by 500. Now, what Sharpe tells me is that even though the return profile of both the strategies is the same 1 lakh, the Sharpe ratio for the strategy where the volatility was only 500 rupees, the second strategy, will be much better than the volatility of the strategy where there was 25,000 rupees of movement. So this way, it is able to give you a risk-adjusted return, that based on the amount of risk and volatility you are taking up, what is it that you are getting in terms of return. So these two rolling metrics should be able to give you a good idea of, one, between any two periods, whatever is the profit or loss, and second, what is the volatility that is there in that strategy. And broadly, the lower the volatility, the better, and the higher the Sharpe, the better. So this way you can get a good idea about that particular strategy. Finally, the last important thing that you would want to see in your particular strategy would basically be the daily summaries, right? Now, these daily summaries, what is this doing? This is basically looking at the entire overall data set, and from this data set, it is able to figure out which day was a Monday, which day was a Tuesday, Wednesday, and so on. For those specific days, so it's now looking at all the Mondays in that data set, and it is giving you that on all the Mondays in combined, you had basically a 44% return. Similarly, on all Tuesdays, you had a 53% return, and so on. So this is able to give you like a good data about on each day of the week what kind of return profile did your strategy have. So now I can see that from my strategy on Tuesdays has basically given me the best performance of my strategy. So in order to further optimize this strategy, I could look for that on Tuesdays, maybe I would let my strategy have a larger target profit, or let's say a larger stop loss as well, because it is giving me that much extra return on a Tuesday basis. But what I can see is that on Thursdays, I can see that the returns has been the least out of all of them. So maybe on Thursdays, I would want to cap my targets, keep my stop losses small, so that my strategy quickly takes an entry. If it doesn't work out, it quickly fails, so that I can stand up again on the next day of the trade with a minimal hit on my overall PNL of that strategy. With this, there is one final thing that we've added in our backtest report that I would love to show you, and that is basically an AI based summary that is added to this particular report. So everything that I did, all of the fancy calculations, all of the discussion that I did is basically converted, and all of the data of your strategy is basically sent to an LLM like ChatGPT. This LLM is processing all this data, and it is giving you a summary of your strategy and the overall backtest report and whatever it has noticed in that report in the form of this kind of a summary that you're seeing out here. Now, what can you do with this summary? You can use this summary to again get insights through a large language data model and understand what kind of returns, what kind of performance explanations, what kind of risks, operational notes, recommendations, all of these ideas that machine learning and AI is doing on the strategy is now at your power using this backtest report at no additional cost. So we have basically enabled this feature very recently, and I would love to know your feedback on how this is helping you or not helping you to actually improve your trading, improve your numbers, and become better overall risk adjusted traders using algo trading and the Tradetron platform. So thank you very much for watching. Until the next video, goodbye.